So guys, red states continue to dominate blue states in terms of the economic rebound since COVID. The Bureau of Labor Statistics just released brand new data on May 2021 jobs figures by state, and boy, let me tell you, it is a doozy for blue states. Places like California, New York, Massachusetts, Illinois, they are all struggling severely. 7 to 10% job losses since COVID, which are depression-level job losses. Meanwhile, red states, comparatively speaking, are doing much, much better. Way fewer job losses to begin with, way more jobs added back, especially in key industries such as tech, finance, accounting. Red states are dominating in those high-wage industries as well. We're going to take a look at all of this data in this video so you can properly understand the huge divergence that's going on across the country economically based on political lines right now. This has never quite been like this in America, this huge political divide in terms of economic progress. And then we're also going to answer the question, what does it mean for you as a potential real estate investor? If you're a home buyer, if you're a real estate investor, where are you supposed to look right now when prices are at all-time highs and job losses are also near all-time highs? You got to use data and you got to pick the right cities and states. So without further ado, let's get into the data. So guys, I'm going to start this video off by showing you the huge differences that exist in America's economy currently by state. And we're looking at on this graph are the job losses by state since COVID. And we can see here that the average state has lost 5% of its jobs from February 2020 to May 2021. Now, what's the color coding on this graph? If the state is red, that means it's a red state. It votes Republican in presidential elections by a margin of 10% or higher in the previous 4. If it's blue, it votes Democrat by 10% or higher. If it's purple, it's in between. And the thing that sticks out immediately, guys, is how red states are just vastly outperforming blue states in economic recovery since COVID hit. I mean, let's just take a look. Utah and Idaho. These are actually the only states in America that have added jobs since COVID, and they are both deep red states. In terms of states with like reasonable to small job losses, South Dakota, Montana, Arkansas, Nebraska, Tennessee, these are all red states. And if we actually go through the top 20 performing states, we can see that about 15 of them are red, 5 of them are purple, and 0 are blue. So this is a huge trend that really no one is talking about. The mainstream media is largely ignoring this, the big economic differences that are going on in America since COVID occurred. If we go to the other end of this graph, we can see a state like New York has lost 9.6% of its jobs over the last year. That's basically 1 million jobs in New York gone. Let's again compare that to a place like Arkansas, which has lost 2% of its jobs. So literally for every one person in Arkansas that's lost a job, there's over 4 people in New York that have lost a job. States like Massachusetts, New Jersey, California, Illinois, and Oregon are in a similar state where they have lots and lots of job losses. So guys, what's apparent from that graph is that red states are doing way better than blue states in terms of economic recovery, and that's really important to consider from a real estate investment standpoint, because the more jobs you have, the more demand you have for apartments and homes, and the higher those values will go. And I think at this point, a lot of people still make excuses for blue states like New York and California. They say, oh, we're still recovering from COVID, and there's not as much international travel, and these states eventually will get back to their previous levels. But guys, 15 months in, those excuses start to wear thin. The longer that this lasts, the longer that businesses stay shut, the longer that people stay unemployed, and the more people who decide to simply pick up sticks and leave these blue states, the more permanent these differences will become. However, guys, we need to dig a bit deeper than simply looking at total jobs lost and gained, because COVID showed that it was not an equal disruptor of the economy. It really hurt certain industries, like primarily leisure, hospitality, food and dining. COVID really hurt those industries because those are in-person industries, right? And so when social distancing and lockdowns happened, those industries took a big hit. On the other hand of the spectrum, work from home friendly jobs and industries like ones in tech or accounting or law, those actually did pretty well during COVID because they could, exist from home, right? So we actually need to narrow our focus here and not just ask, okay, what are the overall job losses or gains by state, but where are the job losses occurring by industry? And that's what we're doing on this map. We're looking at the percentage of jobs lost in the leisure and hospitality sector by state. And leisure and hospitality, that covers things like restaurants, hotels, sporting events, things like that, the percentage of jobs lost in those industries by state. And so, for instance, we can see New York here like leads the way. Prior to COVID, it had 967,000 leisure and hospitality jobs. May 2021, it had 669,000. That's a 31% decline. Nearly 300,000 leisure and hospitality jobs lost in New York. That's the worst of any state in the continental U.S. Over a year later, New York is still down 300,000 leisure and hospitality jobs. We can see here states like Massachusetts at minus 27%, Illinois at minus 25%, Nevada, California, and Oregon around minus 25% have also been hit really hard. If you guys are enjoying the data presented in this video, please just hit that like button. I spent a lot of time preparing and sharing this data for you. I love sharing it. In return, just hit that like button. It gets me more exposure on YouTube and actually allows me to produce more of this content going forward. Additionally, make sure to comment. I want to hear about your experiences in the real estate market and also economically speaking. Have you lost a job? Have you found a new job? What are your thoughts on how these states are differing in terms of their economic growth and recovery? When you guys comment, it makes these videos better. All right, let's get back to the video. Now, guys, one thing I see people say a lot is that these leisure and hospitality jobs, like, we don't need to worry about because A, they say, oh, they're lower wage, and then B, oh, well, they're just going to bounce back as the vaccinations progress and all the lockdown restrictions are lifted. However, guys, when you look at these job losses, I'm really starting to be skeptical that we're going to see rebounds in leisure and hospitality because, again, we're over 15 months into COVID now. We're 15 months in to a place like New York losing 300,000 leisure and hospitality jobs and to all the associated businesses, right, being closed down. Additionally, I think a lot of people try to say, oh, it'll just return when international travel returns, especially in a place like New York or California. Yet when we see a place like Illinois, which has very little international tourist demand, have a 25% decline in leisure jobs, we start to say to ourselves, maybe it isn't all just about international travel and tourism. If we're seeing Illinois at minus 25% or Michigan, a state with hardcore lockdowns, very liberal governor, 22% leisure job loss, maybe some of these leisure job losses are just going to be here to stay. So I have a lot of concern about those leisure and hospitality jobs in states like California, New York, Illinois, Oregon, because the longer that they stay gone, the less and less likely they are to come back, especially if people start changing their tastes, right? Like, people don't need to eat out as much as they used to. They got used to cooking from home. People don't feel like they need to spend as much money as they used to. They got used to saving. I think we're going to see a lot of these leisure and hospitality jobs permanently gone. And that's really unfortunate for the states that have had huge losses in them. Now, with that said, like I said before, these are typically lower wage jobs. So while it's bad that those jobs are, reduced, it's not necessarily earth-shattering to the local economy because the spending power for those jobs, especially over the last 6 months, has been largely replaced by, fiscal stimulus and unemployment assistance. What we really need to look at to get a better picture is, what are the higher end jobs doing? What are the jobs with higher wages, like in tech, accounting, and legal? What are those jobs doing? Because that's going to really tell us like which states are in the bullseye of economic destruction and which states are on the ramp up of economic growth. And where I want to go for this is, again, to the Bureau of Labor Statistics. They track an industry segment called professional, technical, and scientific services. Professional, technical, and scientific services. And this is an industry that tracks like a lot of these high wage, high caliber jobs. It tracks tech, it tracks accounting, it tracks architecture, law, it tracks a lot of stuff like that. And it has the highest average wage of any industry segment that the Bureau of Labor Statistics tracks. So let's look into what the job losses look like and the job growth looks like in professional, scientific, and technical services by state. This is going to really give us some key insight into which areas of the country are expanding versus declining economically. So guys, what we're looking at on this graph are the cumulative job losses and then gains in that professional and technical services segment. And the red line is tracking the cumulative losses and gains in red states, which we looked at what those red states were before, and then in blue states. And what's evident is that the differential in performance between red states and blue states isn't just segmented to leisure and hospitality. We can see here that's in professional and technical services, where red states through May 2021 have actually gained 2.7% jobs in this key segment since the start of COVID. So red states are up in this high caliber job segment, while blue states are still down at minus 1.2%. And so this is what makes you start to really be attracted to red states from a real estate investment standpoint, is that they're not just gaining like low wage jobs. They're gaining high wage, high caliber jobs. And we're seeing that during COVID especially, but this has actually been a trend that's lasted over the last 20 years. Now we're shifting this graph to look over the last 20 years, the job gains in professional and technical services. And we can see that red states have gained 62% growth in this job segment over the last 20 years, while blue states are at a mere 29%. Wow, so the growth rate in these high caliber jobs is twice as high in red states over the last 2 decades. And that trend is showing up in the short term as well from the rebound from COVID. And this is the important point to consider, is that this is just not a short-term trend of red states outperforming blue states economically. This has been something that's happening for decades, right? And there's probably a variety of different reasons for it. One thing is definitely actually the weather. Red states tend to be in warmer climates, and weather has been shown to be like one of the most predictive factors for where people and jobs move over the last several decades. But of course, other reasons include more favorable business climate. Red states tend to have lower taxes, lower regulations, lower minimum wage rules. They allow business formation easier. And I think a lot of people, a lot of businesses are saying to themselves over the last couple of decades, especially also the last year, hey, I don't want to deal with all the red tape and the BS that I have to deal with in blue states. I'm going to red states, right? So that's one reason. And then, of course, in the short term, the COVID lockdowns are another. I think blue states really did a lot of damage to themselves, economically speaking, and from a societal standpoint, with the heavy COVID lockdowns. Not maybe initially, but it was like the resistance of rolling off those lockdowns in states like California and Michigan. It's just like they stuck with them for so long, even as the evidence started to show that they weren't necessarily as effective as we thought at stopping COVID spread. So you have red states gaining in total jobs both in the short term and the long term. You have them gaining in professional and technical jobs in the short term and the long term. And it's got to make you, as a real estate investor or home buyer, really want to start to look to red states as places to invest, right? Because job growth, guys, let me tell you, a lot of people are trying to say these days that jobs don't matter anymore because, I don't know, they try to say, oh, it's only low-wage jobs that have been lost. They try to say fiscal stimulus is here forever, or they say UBI is here forever. Guys, jobs still matter a lot. That metric is telling you a lot. Job growth is telling you a lot about the vitality of the local economy. It's telling you if people want to move there. It's telling you if there's economic opportunity. It's going to tell you if real estate prices are going to appreciate into the future. So we need to marry this together now. We looked at all this data. How does it compare, so let's just say, to real estate appreciation by state? And this is kind of the thing we got to start looking at now. Job growth versus real estate appreciation. Going back to what I talked about in the intro, we have this big divergence in America right now where home prices are going up crazy amounts. Main Street economy is struggling. We want to target markets that have a good balance between the two. We don't want to be in a state or a city that's had runaway appreciation above what the job growth indicates. Because it's likely that that state in the peak of an economic bubble is going to have negative returns over the next couple of years. It's going to see declines in price. And guys, so we're making that fundamental comparison on this graph where we're looking at by state the percentage job growth from 2016 to 2021, May 2016 to May 2021. And we're comparing that to the growth in home prices in that state over the same period. And what I want you guys to pay attention to are two things. I want you to pay attention to this yellow dotted line because that shows the relationship between the two. And we see here an R squared of 0.62, which means that the job growth from 2016 to 2021 explains nearly 2/3 of the variation in home prices. So job growth is still a huge determining factor of how much home prices increase in America, even after the craziness because of COVID. Now, the other thing I want you to pay attention to is the color coding. The color coding of the states and the dots on this graph. States colored red, no longer does this related to political affiliation. States colored red have seen higher appreciation than you would expect given the job growth. So for instance, in Idaho, Idaho's experienced 93% home price appreciation in the last 5 years, but 13% job growth. While that job growth is actually the highest in America, that home price growth is also by far the highest in America, and that appreciation is really like above what you would expect given that job growth. A place like Washington is a similar situation. Jobs have increased by 3.6%. In that span, but home prices have increased by 62%. So these states in red, Arizona, Nevada, Maine, Michigan, are probably ones that we want to avoid investing and buying into in the peak of a housing bubble, because prices have already appreciated far above what the economic fundamentals are suggesting. Now these states in blue offer kind of a better value proposition. So for instance, in Arkansas, jobs have grown by 2.8% in that span. Home prices have only grown by 29%. So like we can see Arkansas and Nevada have like the same job growth, but Nevada's home price growth is double. I feel better about buying into Arkansas today based on that than I do Nevada. Some other states would be Virginia, Alabama, South Dakota, South Carolina, Texas. In general, these states have had more reasonable levels of appreciation relative to the economic growth that they are experiencing. And that means they are likely safer investments, all other things equal. Now that all other things equal is a key caveat here, guys, because there's other things that matter in addition to job growth. Things like how much new housing supply is getting built is also a key indicator. If one state is building too many homes, it might have a downturn in the housing market. If a state is building too few homes, it might continue to see appreciation in the housing market. Another thing that we want to consider is wage growth, especially now in mid-2021 where we're starting to see some inflationary pressures. We're going to want to see how much wages are increasing in different states and different markets across the country, because that's going to be another key indicator of how sustainable home price appreciation is. Guys, in aggregate, I think the moral of the story here is that red states are doing very well economically compared to blue states, both in the short term and the long term, and this is no accident. When you combine the, in my opinion, better response to COVID from an economic and societal standpoint from the red states with their more favorable business-friendly rules and regulations, you get a much better environment for growth. You get a much better environment for attracting people, attracting businesses, and attracting sustainable increases in growth. The blue states, particularly ones like New York and Massachusetts and California and Illinois, they have real problems right now because for over 15 months, they're down 7, 8, 9% jobs. That's a mammoth amount. And the longer this lasts, guys, the more permanent it's going to become. I'm telling you that right now. There's been lots and lots of research done on long-term unemployment, and it's very bad for people in society when people are out of work for more than 6 months, more than 12 months. Bad things tend to occur. And so don't be surprised if these differences between red and blue states get locked in, become permanent. We see a permanent geographic shift in how the economic growth is distributed in this country. One thing I'm going to be watching out for over the next couple months is extended unemployment insurance. And basically at this point, I think about 25 states have now turned down extended unemployment insurance and the top of $300 a week from the federal government. And most of those are red states. Most blue states are still accepting that extended unemployment insurance. So it's going to be very interesting to see over the next couple months how these differences in job growth and recovery progress. My prediction is that red states are going to continue to gain based on accepting the fact that extended unemployment insurance was a disincentive to work. They're likely going to see more jobs come back. I think blue states are going to lag the longer they hold on to this extended unemployment insurance. Of course, that's just my speculation. We're going to have to check the data in a couple months' time to see what it says. Now, guys, we need to talk about something real quick. I was looking at the data on my channel. Apparently, 85% of my views come from people who are not subscribed to the channel. I want to change that. I want to lower that number. So make sure to subscribe going forward. I have a lot of this content coming out, 2 to 3 videos per week. On Sunday, we're going to talk about the cities in America that are going to be the first to experience the upcoming real estate crash. We're going to look at real-time data on housing inventory and housing bubble status to see which cities, which parts of America are going to experience the crash first. And let me tell you guys, it's right around the corner. You're not going to want to miss that episode coming on Sunday, so make sure to subscribe. Until then, guys, this is Nick from Reventure Consulting signing off.